The day the US Mint quietly stopped selling silver wasn't announced with sirens or headlines. It happened in silence. And silence in financial markets is never accidental. When the world's most trusted silver supplier steps back, the real question isn't why. It's what they know that you don't. What you're about to hear isn't speculation or internet panic. It's a chain reaction already in motion. The US Mint has suspended all silver sales, not some, not limited, all. No new orders, no restocks, no timeline. And when that happens, it sends a signal through the entire global silver market, from coin dealers to industrial users to central vaults in London. Silver isn't just a shiny metal sitting in a safe. It's a lifeline for technology, energy, defense, and finance. And right now, that lifeline is tightening. To understand why this matters, you need to understand what the US Mint actually represents. It's not just a coin shop. It's a demand valve. When the Mint sells silver eagles and other products, it draws metal out of the wholesale market and into public hands. When it stops, it's not because demand disappeared, it's because supply couldn't keep up. Historically, the Mint only suspends sales for one reason. They can't source enough physical silver at acceptable prices without blowing up the system. That alone should make you pause. This isn't the first time we've seen this movie, but the setup is far more dangerous now. Industrial demand for silver is exploding. Solar panels, electric vehicles, AI infrastructure, medical devices, military hardware, every single one of these consumes silver permanently. Unlike gold, silver doesn't come back. It gets used, scattered, lost. Recycling helps, but it doesn't close the gap. Mining supply has been flat for years while demand keeps climbing. That gap doesn't stay open forever. It snaps shut. At the same time, investors are waking up, not because of hype, but because trust is breaking down. Inflation never really left. Interest rates didn't fix the debt problem. Banks didn't become safer. Governments didn't become more disciplined. When confidence erodes, people don't rush into complex financial products. They go simple, tangible, something they can hold. Silver sits right at that intersection of affordability and necessity. Now here's where it gets uncomfortable. The paper silver market is massive compared to the real thing. For every ounce of physical silver, there are dozens, sometimes hundreds of paper claims, futures contracts, ETFs, unallocated accounts. Most of it works as long as nobody asks for delivery. But when physical demand spikes and supply tightens, that leverage becomes a liability. The US Mint stepping aside doesn't reduce demand, it redirects it. People don't stop wanting silver, they go elsewhere. And that elsewhere is already strained. London plays a critical role here. It's the heart of the global silver clearing system. Massive vaults, institutional flows, paper. Contracts settled on the assumption that physical metal is available if needed. But assumptions are fragile. When physical silver drains out faster than it can be replaced, the pressure doesn't show up immediately in headlines. It shows up in delays, premiums, back orders, settlement games, quiet rule changes. Then suddenly nothing is quiet anymore. What makes this moment different is timing. We're not heading into a strong, stable global economy. We're heading into slower growth, higher costs, geopolitical tension, and financial fragility. That's when supply chains break. That's when governments prioritize themselves. That's when official sources stop selling to the public, not because they want to, but because they have to. If you're wondering why this isn't front-page news, that's part of the pattern too. Real supply squeezes don't announce themselves loudly. They creep in through administrative decisions and temporary suspensions. By the time the average person notices, the metal is gone and the price has already moved. And this is why the US Mint decision matters so much. It's not the event, it's the confirmation. A confirmation that the silver market is far tighter than advertised. A confirmation that physical availability, not paper pricing, is starting to dictate reality. And a confirmation that what's happening now is setting the stage for something much bigger. Because the real stress point in any commodity market is never price first, it's availability. The headline you see after the damage is already done. Availability is the warning signal. And right now that signal is flashing bright red. When a sovereign mint can't secure enough metal, it means wholesalers are tight. When wholesalers are tight, it means refiners are stretched. And when refiners are stretched, it means the raw material simply isn't flowing the way the paper market pretends it is. Look closely at what's happening behind the scenes. Dealers aren't discounting silver. They're charging higher premiums. Delivery times are extending. Product variety is shrinking. These are not signs of weak demand. These are signs of rationing. The market is quietly telling you that silver is becoming harder to source at scale. And once that starts, it rarely reverses quickly. Now layer in the industrial side. because this is where silver becomes completely different from gold. A solar panel doesn't care about spot price, it cares about supply certainty. Manufacturers don't speculate, they secure metal months or years in advance. If supply becomes unreliable, they stockpile. That removes even more silver from the open market. It becomes a feedback loop. Less supply leads to more hoarding, which leads to even less supply. This is where London comes back into focus. The London silver market is built on confidence. Confidence that vaults are full, confidence that contracts can be settled, confidence that metal can move freely across borders. But confidence is not metal, and idence can evaporate very quickly when physical demand increases while mine supply stays flat or declines. A single stress point doesn't break the system. Multiple stress points do. We've already seen subtle changes. More cash settlements, more delays framed as logistical issues, more emphasis on paper rollovers instead of delivery. These are not random. They are pressure management techniques. They buy time, but they don't create silver. And time is exactly what the system may be running out of. What's important to understand is that this isn't about running out of silver entirely. It's about running out of available silver at current prices. Markets clear through price. If enough people demand physical delivery, the price must rise until demand is destroyed or new supply comes online. But new silver mines take years, not months. Recycling ramps slowly. There is no quick fix. This puts governments and institutions in an uncomfortable position. Do you allow price discovery and risk exposing how tight the market really is? Or do you restrict access, suspend sales, and manage perception? History tells us which option is usually chosen first. Control the flow. Delay the signal. Hope conditions improve, but hope is not a strategy. And for individuals watching this unfold, the lesson is simple but not easy. By the time a supply squeeze becomes obvious to everyone, the opportunity to act calmly and rationally is gone. Decisions become emotional. Prices gap higher. Availability die. Disappears overnight. The US Mint stepping away is not the end of the story. It's the early chapter. It's the moment when the curtain lifts just enough for you to glimpse what's happening backstage. And what's happening backstage suggests that silver is moving from an abundant, ignored metal into a strategic, contested one. And once that transition begins, it rarely moves in reverse without something breaking or repricing dramatically. That's the fork in the road. The silver market always reaches when supply and demand drift too far apart. Either demand is crushed through economic pain or price rises until the balance is restored. There is no third option. And right now, nothing suggests demand is about to collapse. Think about the incentives. Governments are pushing green energy harder than ever. Defense spending is rising, not falling. Data centers are expanding. Electrification is accelerating. All of this consumes silver. None of it is optional. At the same time, miners face higher costs, stricter regulations, and declining ore grades. You can't flip a switch and produce more silver. The pipeline is rigid. That rigidity is exactly what turns shortages into squeezes. This is why the phrase temporary suspension should make you uneasy. Temporary often becomes permanent when the underlying problem isn't solved. We've seen it in energy markets. We've seen it in food exports. We've seen it in bond markets. Restrictions appear quietly, framed as precautionary. Then they linger. And while they linger, behavior changes. People stop trusting easy access. They move earlier. They move faster. They take metal off the market and don't give it back. If London feels this pressure next, it won't announce it with a press release. It will show up in small ways. An extra week to settle. A preference for cash. A sudden rule adjustment. For institutional players, those signals are loud. For the public, they're invisible until the effects spill over into price and availability. That's how confidence-based systems unwind. Slowly at first. Then all at once. What makes silver unique in this moment is its dual identity. It's both money and material. When financial trust weakens, people want it as a store of value. When industrial growth continues, manufacturers need it as an input. Those two forces don't compete. They stack. And when they stack against a limited supply base, pressure doesn't dissipate. It concentrates. This isn't about predicting an exact price or date. That's the wrong way to think about it. This is about understanding structure, understanding flow, understanding incentives. The structure says supply is tight. The flow says physical silver is leaving the market faster than it's being CED. The incentives say demand is not backing off. When all three line up, markets don't stay calm. The US Mint didn't cause this. It revealed it. Like a thermometer in a fever, the reading isn't the illness, it's the evidence. And ignoring evidence doesn't make it go away. It just delays the response until it becomes unavoidable. Here's the part most people miss. Supply squeezes don't reward speed at the peak. They reward awareness before the crowd arrives. By the time silver is on every headline, by the time commentators are shouting targets, by the time shortages are openly acknowledged, the easy decisions are gone. What remains are hard choices under pressure. Silver has spent years being dismissed as boring, manipulated, and irrelevant. That's often how critical assets behave right before they matter most. Quiet, undervalued, taken for granted, until suddenly they aren't available anymore. The suspension of U.S. Mint silver sales is not an isolated inconvenience, it's a signal flare. A warning that the physical market is tighter than the paper price suggests. A hint that the world is moving into a phase where access matters more than promises. Whether London is next isn't the real question. The real question is whether people recognize what's already happening before the squeeze forces everyone to recognize it at once. And when that moment arrives, silver won't need hype to move. It will move because there's not enough of it to go around.